Today's Money Tuesday segment, we're wrapping up our series on investing for the ages, and we're focusing now on the retirement age and beyond. Stewart Welch of the Welch Group joins us once again by FaceTime. There he is, with more advice for you. Good to see you this morning, Stewart.
Good morning, Mike.
Yeah, we started with folks in their 20s, and we've worked our way up at different stages of their lives, what should their strategy be in investing, and now we're at the age where I get to go buy a yacht. Is that correct?
You're right, and I'm going to join you when you get it.
Yeah, I wish. All right, let's talk about that. What types of strategy do we need to start thinking about if we're in this age group where, we're 60 and above now?
Yeah, let me just do a quick recap. The
Okay.
20s and 30s, we were all stocks, pretty, very aggressive. When we hit 40, we began to introduce bonds into the portfolio. Now we're turning 60, headed toward retirement. We're pre-retirees. What is critical at this point is that by the time you retire, you have a safety net that's going to equal a minimum of 3 years of annual expenses, and that's after you figure in your Social Security, whatever's not covered by Social Security. So that's critical, because what you don't want to do is put yourself in a position of having to sell stocks when they're temporarily down because of a need for cash flow. So one of the things that people ask me is how much should be in this safety net, and so we built a scale, and I found most people are very conservative once they get to retirement and they don't have a paycheck. So for the conservatives, we would say you'd want 10 years of annual expenses in either bonds, CDs, or money market funds. And if you want, and that's, by the way, Mike, enough to cover, that's 2 times what it takes to cover the worst bear markets in recent history. So if you wanted to be a little more aggressive in that moderate category, you would have 5 years to 9 years. And if you were aggressive, if you wanted to be much more aggressive and have more money in stocks, that would be 3 to 4 years. So that's the scale, and that's kind of the part one. I think the part two of that is you want to take a look at your stock portfolio, and now you want your stocks to be more conservative. So we would shift away from more growth-oriented stocks to more value-oriented stocks, and we favor large cap, blue chip companies that not only pay dividends but have a long-term history of raising dividends over time. So that'll give you a buffer. Now they're still volatile,
Sure.
and that's why you need that safety net.
Stuart, we only have about 15 seconds. I want to ask you, let's just say you're at that age where, look, I'm no longer going to be working and I want to cash out my 401k. Not cash it out, but I mean, could I roll over a huge percentage of that into bonds, and that would be a good way to go, like a large percentage? And if so, what percentage?
Yeah, so Mike, again, I think that is a smart strategy. And when you do that, you're obviously not going to be forced into any taxes, because you're going to roll from a 401k to an IRA. And this is where it's really critical to get with a certified financial planner and get you to help them, because these are critical decisions. That percentage is going to be very personal, and that's one where you're going to need to sit down with somebody.
Gotcha.
If you don't feel comfortable doing it yourself, sit down with somebody who's a certified financial planner.
All right, Stewart Welch from the Welch Group. Always appreciate it. Thank you, sir.
Thank you, Mike.
Yep.